Hey everybody. All right, today we're going to be talking about non-current assets. But let's talk about where we've come from too, right? We have already talked about current assets and current liabilities, excuse me. All right. I put those together for a reason because it's going to be important later on when we are talking about some other analytical tools related to the balance sheet. But our topic of discussion for today is non-current assets. So the first thing I want to talk about is really what the definition of an asset is. And basically, it's any sort of a resource that the business has, right? Cash is one, right? We talked about that in our current assets section. We've got accounts receivable, but you can also have some other assets that, like a buildings could be an asset, vehicles could be an asset, software and technology can be assets, okay? But I want to drill down and have you guys think about this a little bit more deeply, because some assets are really a drag on the business where others are generating revenue. And here's an example that I want y'all to think about. An AC company, let's take an AC company, an HVAC company, and they've got a vehicle, and that vehicle allows them to put technicians on that vehicle to generate sales for the business, right? So just a quick question. If we were to take and use the resources that we use to purchase that vehicle, allowing techs to go out on calls, and use it instead for the owner to drive a really nice car, and that asset's also on the books, which asset has the most value? And the way that I look at that is that, they may have the exact same cost to them, but the one with the technicians in it is driving revenue. And that is really the way I want y'all to think about assets. They should be generating revenue for you. Okay? So anyway, let's talk a little bit more deeply about the different types of assets. I tell you what, when it comes to non-current assets, this list can really get long. I've only put a few items in here, and we're gonna start with property and equipment. Okay, property and equipment is going to be those kinds of items that it could be vehicles. You could be running some sort of an industrial shop. It could be all of the equipment that you guys someone may be using for fabrication. Okay, property, that could be land, that could be buildings and that sort of thing. Now, technology and software, that's a little bit more of an intangible type of an item, meaning it's not something that you can touch, right? You got your vehicle that is out in the parking lot. You can go out and touch that vehicle and it's there. But if you've paid a lot of money to use another business's software, you've paid it all up front, and you're going to amortize that cost over a period of time, it's going to sit on your balance sheet like that. Okay, so that's an example of technology and software. And then you've got other intangible assets like goodwill or patents and that sort of thing. I don't run into this too often with most of my small business owner clients, but it does happen from time to time, and it's still important to know. But there are values. There's value in patents. I don't know if you've ever watched Shark Tank, but they are, the sharks are always asking the presenters if they have patents pending or whatever the case may be, because there's a lot of value in having those ideas protected. And again, it's intangible. You can't go out and touch it, but it still has value. Okay. And then the other item that we have on the list here is depreciation. And we could add the word amortization. And honestly, those two words I feel are really, they can be confusing. I personally think that as accountants, we like to make things more complicated than they are. There's another word called amortization that is basically the exact same thing as depreciation, but they are applied to different types of assets. That's really the only difference between depreciation and amortization, okay? And the addition of all of those items brings us to total non-current assets. So not too terribly complicated. So that's where we are. And again, we've been expanding this, this accordion, if you will. We've talked about current assets. We've talked about current liabilities. And now look at where we are. We've also talked about non-current assets. So I bet you guys can probably figure out where we're going next. We're talking about non-current liabilities. That's going to be the next expansion of our balance sheet. So if you guys have comments, questions, drop them in the comment section. And if there's something, again, if there's something that you guys want to have me go over, I would love to hear what that is. Anything that you guys want to know from an accounting, financial statement perspective. I know this is probably one of the most boring topics in the world, but I love talking about it because it's just not talked about enough. And no one's taught us this stuff. We did not learn this stuff in grade school or even in college, but it is so incredibly important because this is the scorecard. This is the scorecard of money, and this is the scorecard of business. So this is so important. I just can't express that enough. So anyway, like, comment, most importantly, please like the page or follow our page. And I can't wait to talk to you guys next week when we actually start talking about non-current liabilities. And can you see, hopefully you guys can see how this picture is starting to come together. Bit by bit, it comes together. And to me, that's really super exciting. So until the next video, we'll talk to you then. Bye.